line in the sand. I'm Philip Zappacosta from Strategic Wealth Preservation. We're based in the Cayman Islands, and we are a precious metals dealer with vaulted storage services worldwide for our clients.
Hi, I'm Efrem Hoffman, founder and CEO of Running Alpha Investments Incorporated. I founded a market intelligence firm back in 2012 to help high net worth investors and family offices understand the movements of capital, people, and ideas in world financial markets. In the Line in the Sand series, I'm going to be here to actually apply a technology I developed in the 1990s with Environment Canada in order to actually understand catastrophic events in nature, specifically tornadoes, and apply it to volatility storms in financial markets. I'm hoping that listeners will be able to glean new insights into what's happening in the world today, given the extreme uncertainty. The tools designed today are not designed for understanding how aberrant events and unusual situations and 1,000-year floods, like events like the 2008 crisis, events like the housing crisis, and events like the pandemic will affect financial markets. I'm here to apply that technology so that we can understand catastrophes in finance.
Well, I'm fascinated and really excited to have you here today, Efrem. So let's jump right into the questions so we can get our audience the answers they need. So Efrem, there's been a lot of discussion going on that basically people are not going to use precious metals as a hedge against inflation anymore, because now there's so many investors flocking to Bitcoin and other crypto coins. Do you see this as a trend that's going to persist going forward?
Actually, quite the opposite. I actually am really enthusiastic about how silver has been behaving in the process from its low since last year and how it retraced. And we're really getting close. And I'm going to share a chart with you just a bit later on in this question that's going to actually show how silver is just about getting ready to take its next leg up. That will be quite dramatic. And I do believe that when you look in the context of silver to Bitcoin, they're two very different things. Silver has been volatile, and it is one of the most volatile coins, but Bitcoin is many factors of order more volatile. There's a lot involved in terms of getting it set up and not making a mistake and losing your Bitcoin address. It's also extremely transparent, not as private as people think it is. And I believe that investing directly in precious metal, bullion, silver, and gold in a jurisdiction of privacy makes sense, whether it's offshore or in a secret vault onshore. I also believe that it's not just a hedge against inflation, something like silver, but it's actually a critical resource needed in the new economy, from 5G technology, communications, that the heart of our entire technological segment is based on. And it's also going to be needed for medical technology applications. It's going to be needed for the electrification of the energy grid, which is a very critical area today to deal with. And if we don't deal with that, we could have a problem with food shortages. We could have a problem with blackouts, and lots of people could die unnecessarily unless we make the proper investment and actually bring supply back to the market to meet the demand. But right now, supply is so low compared to what the future demand is going to be, and investment demand due to inflationary forces, which we'll talk about later, that I'm quite concerned that if investors are looking and thinking that, hey, it's not important to be thinking about allocating to gold and silver, they're missing out on one of the best investment opportunities of a lifetime.
And how do you think it relates to inflation specifically? Do you think inflation is going to persist going forward?
I actually do believe so, because right now it's not demand driven. This is inflation driven by supply shocks and supply chain bottlenecks and trade wars and all kinds of policies imposed by governments that are interacting all at the same time. And it's not something that just one local government or local nation has complete control over.
And is there a chart you could show us to kind of get a better visual of how you see inflation over the upcoming years and currently, so we can
Yes,
better understand also how precious metals would be still a hedge against inflation?
for sure. The chart I'd like to show you is the CRB Index, which it's a company called the Commodity Research Bureau, and they put out the stats on the broad index of commodities, how they're actually moving. And it's all the commodities pretty much that make up the necessary raw inputs that go into industrial production. And that includes that from agriculture to copper to metals. So it's quite broad. But this chart is actually a ratio chart, which means that it's taking the index, the broad index of commodities, and it's dividing that index by the 10-year treasury yield. The reason why I'm doing that is because inflation occurs, or signs of future inflation occur when commodities, the prices that could flow through the system, ultimately reaching the consumer, are increasing faster than the rate at which the treasury bonds pay interest. And right now we're in a negative yield, a real yield environment, which means that we're in a situation where the rates that the treasury bonds are paying is actually much, much lower than the pace of inflation as recorded by the consumer price index, as well as the pace of inflation as recorded by the raw materials that are made up in the CRB. And I'm showing this chart because right now, just to add some clarity to the chart, because most people that look at charts will typically be used to looking at either bar charts or candlestick charts, where each bar represents the high and low of a given period of time. This chart just happens that each bar represents a 3-day price range. And it starts off, this chart, what you can see is to the left, you could see it going back to 2021 and up to where we are in today's date, which is right over here. These other boundaries that you see, don't pay attention to all this noise and all these boundaries that you see to the left, but to the right, all these boundaries are not moving averages that you typically see in technical charts. They actually represent areas of zero momentum in terms of how traders in the future will be seeing momentum. So I'm going to focus, I have a lot of back end calculations that are done to actually crunch the numbers in order to show something so that you only have to focus on one of these lines. So the line that I'd like you to focus on only in this chart is this purple boundary that I'm moving my cursor across. And that boundary extends into March of 2022. And as each new price bar forms from today's date onward, a new piece of this purple line will be added. And we will update that to you in future episodes. But the point is, when this line is sloped down, what it means is that the perception of investors and traders in the future are going to be for a positive bias in the direction of the price of the asset that we're looking at. So in this sense, in this chart, we're looking at the ratio, and it's telling us that going into the November period, and especially going into the first quarter of next year, we're going to see the commodity index relative to the 10-year increasing in value, which is a sign that there'll be inflationary forces because of commodities will be rising faster than the yields that are artificially kept down due to the low interest rates that were implemented by the Central Bank of the United States.
So does the Fed really have control over the matter at hand at this point in time with their policies?
Well, at this moment in time, don't actually believe that the Fed has control, because as I said earlier, we're in a situation right now that's a supply shock driven situation. It's not like the Fed is trying to, raise rates or trying to pull away, actually start tapering and removing QE from the system. They're not doing it because they think that there's just so much demand in the economy. They're doing it because they artificially kept rates too low for too long, that they want to make sure that they just normalize to the fact that the economy is going to be reopening. And in fact, even before the pandemic, these rates were kept artificially too low. So this is due, but the problem now, because of the pandemic and because of the fact that it's not just the United States that's competing for these critical commodities, but it's the whole world that's in high demand for food resources and for the technological kind of materials like silver and other critical semiconductor materials. And because of that, you're going to have a situation where no matter what the Fed does in terms of raising rates, lowering rates, it doesn't matter, that ultimately you can't just turn a switch on and say, hey, let's just grow a new mine and pull it out of the ground. Right now, the legislation and regulation is so onerous that it could take up to 20 years to actually get a permit to a new mine. And that's if you even find a mine that actually has enough high throughput. So there is a lot of projects happening today that I have been following in the silver and gold space, and which we'll talk about in further episodes. But right now, I could basically say that this is something that is going to be going on for years to come. And we'll talk about that in some other episodes for sure.
So Efrem, I know you're really excited to show our viewers the silver chart, and we're going to get to that in a minute. But just before we move on to discuss that, I really want to conclude this discussion around tapering. And I want to understand how it would impact the stock market and when we should really see this tapering start to come into effect.
Yeah, I like to first start off and say that a lot of people are focusing on some of the wrong things right now. And I think it's getting people mixed up about, or kind of making them doubt themselves about whether to buy silver or gold, because they keep on hearing the media saying, when is the Fed going to taper? Or the Fed keeps on coming on and, says we're going to start tapering. And then they start like questioning it 2 days later and saying, well, we may do it slower. There's just so much uncertainty. And it's not just uncertainty by the individual, but uncertainty by the Fed. So if the Fed doesn't even know exactly how they're going to taper, they know they're going to taper, but they're still watching other numbers. So they have an out on whether they actually taper. They'll say, oh, well, this number was a little bit too low or that was too high. Therefore, we're just going to taper a little bit. So I don't think anyone really knows how much they're going to taper, but I can tell you one thing is that effectively the market and has already signaled that tapering has taken effect even before the Fed has tapered. It's just the same, like a lot of times, like the Fed doesn't have complete control over interest rates. The open market, it trades on the open market. And if there are pressures in the market, in the futures market, that indicate that people believe that inflation is going to be a lot higher, they're going to actually drive the bond prices a lot lower and drive up interest rates and force the Fed to do something. Because if interest rates are forced up too high and the Fed keeps them artificially too low, that could cause problems in the economy. So I believe it's the same thing, that the Fed is paying attention to the signals that the market is giving to whether tapering has already occurred. And there has been a big signal. I don't want to go into the details of monetary policy because that could be for a more advanced show. But what I would like to say is that we've reached a debt saturation limit in the banking system. And what I mean by that is that normally in a functioning economy that's doing well, in a functioning system, banks love to have more reserves so they could loan money out so businesses could grow and the economy could grow. And if it grows fast enough, that could offset inflation, because if the GDP is actually higher to that's a good thing. You know, if GDP is matching the rate at which the money is growing, then it's fine. But if you have a situation where the GDP is low and there's a heck of a lot of money being printed, that's an issue. So my concern right now is that, as I said, the Fed usually gives reserves to the banking system. Well, since May of this year, at least over $1.4 trillion of reserves have been removed from the banking system, in the sense that they are actually loaning out treasuries to the government, the banks, in the tune of $1.4 trillion. And they're doing it on the short end of the market, like overnight, and also just quite short term in nature compared to what the Fed is doing in terms of buying long-term treasury bonds on the long end of the market. So you really got to distinguish the two types of tapering. But the fact that the banks are actually loaning out and saying, hey, we have too much in reserves, is a sign that there's not enough good collateral in the banking system to back up new loan growth. And also the banks are scared right now about inflationary forces and don't want to have a lot of excess fiat cash in their system. So, and also, you know, with a lot of collateral not being sufficient in the banking system, it's in the interest of the banks to actually have more treasuries on hand than cash, because treasuries are more valuable to banks when banks have to meet the requirement in terms of their reserves to loans and all their liabilities. So treasuries are king right now, but there's a competition for treasuries between the Fed and banks. Now, here's the thing. The thing is, from the Fed's perspective, they're concerned that interest rates could go negative in nominal terms, not just real terms. And they got extremely close. And if not, like, they would have gone negative had the Fed not removed liquidity and removed excess cash from the banking system, and actually took that cash and gave treasuries to the banking system. And because of that, the Fed was able to keep nominal yields above the zero mark. And that's what the Fed was quite concerned about. And that's why all that money has gone that way. Now, if there actually is tapering that takes place in the long end of the curve, like the Fed is talking about right now, what that's going to cause is it's not going to deal with the situation that we have on hand, because a lot of the inflation in the system has not passed through to the consumer yet. Some of the numbers that they actually track at the Fed have a lag of up to 15 months. And we know already that those numbers have been escalating for quite some time. So even no matter what they do, there's a large series of numbers that are going to be going up in value from the inflation point of view. And the Fed can't just increase rates so dramatically to offset such deep negative yields right now, because if they actually do that, we're already in a panic situation where just recently the debt ceiling was reached, and there was an impasse, and then finally a vote says, okay, you know what, we're going to extend it into December. But could you just imagine if the Fed was to actually raise rates dramatically to offset inflation? What would happen? You'd have a situation where they would have to raise the debt ceiling so dramatically, and one of two things would have to happen. Either they'd have to do a whole new round of QE to actually printing money to actually pay for that debt, because it would go up dramatically with higher interest rates, or they'd have to find foreign buyers of treasuries, which are already showing signs that they're not interested. For the past number of months, there was a virtual drop-off in Asia, especially China, which is a big player in the treasury space. So my concern is that you don't have too many options to choose from. You either choose a devaluation of the US dollar, which is extremely bullish for the price of gold because it's priced in US dollars, also equally bullish for silver, or you have to not taper as much and continue to have negative real yields, which is bullish for gold. So in any one of the scenarios, it's really irrelevant whether the Fed tapers, because they can't taper enough to make a difference. And it's already too late, and there's a lot of inflation that hasn't passed through to the consumer, which is going to over the coming months into 2022. I believe 2022 and 2023 are going to be a nightmare for the Fed.
And what do you think the impact will be on precious metals as this inflation passes through?
Well, I think now would be a great time to share a chart of silver, which is my favorite precious metal in terms of reward to risk, just because of how much it has underperformed gold. And especially considering that, as I said earlier, silver is going to be a major contributor to the electrification space in the future. So let me just put the silver chart up right now. So what you're seeing here is a chart of silver going back to the European crisis of 2011, where we had silver reach a high of 49.83, challenging the high when the Hunt brothers cornered the silver market back in the 1980 period. And it also shows the descent to the lows of silver that were made at a level of, well, it descended into 2015 in December down to a low of 1369. And then we had that rally, that dramatic rally off that low, like, because just before actually the pandemic, silver was starting to recover, and we got up to like 1894 in the February period, and then just tanked in a very, very short period, going into the April period, going into the March period, to a low of 1163. So you could just see how volatile silver can be in a very short period of time. And this is just something that you have to contend with. And then it had this dramatic rally very, very quickly into July of 2020, up to near $30. And then it retested that high, not with a lot of conviction, just going slightly above it, and then pretty much falling out of bed and being kind of, let's put it this way, not very attractive to people that believe that silver and precious metals should be going up. They feel as if it wasn't really, reflecting what should happen given everything that was going on in the economy. But markets sometimes could get ahead of themselves. Like you have to really put this thing in context. And that dramatic rally that we had in a very short period of time off that $11 low area to go to 30, like triple, which is just massive. I mean, and some of the stocks doing dramatically more than that. It's just natural to get a retracement. And typically in stock markets, I mean, people are very familiar with, 38 or 50% or 62% retracements, sometimes even 70+% retracements. As long as the prior lows are not taken out with conviction, you're still in a secular kind of bull market. And I don't care what kind of analysis you look at, as long as you're looking at the right time frame, you could see the context. If you're a day trader or somebody looking at like charts where they're plotting, you know, a very short term window, let's say of like just a couple years, aren't going to really be able to make sense out of it, because the actors that are actually creating the supply and demand on the investment side require one to actually look at the full interaction of traders going back very long periods of time, because there are people that actually hold these commodities for long periods of time. There are people that acquire it over a period of years. And when they're making decisions to buy it, they don't look at short periods of time. But you can't make an assumption that who's going to show up in the market at any given day, which is part of the reason why I have these boundaries on here. Every one of these lines you see here, as I said before, they're not moving averages. They represent how momentum will be interpreted in the future by different market actors on different time horizons. So by overlaying all these time horizons of zero momentum, so if price was to land on any one of these lines, it means that anything above the line is going to be interpreted as positive momentum, and that will add buying pressure to the market. And anything below a line is going to add negative momentum. But that's easy to say. But how do you predict if price is going to be above or below the line? Because I said if it's above the line, well, that's an if. So I developed a mathematical algorithm that actually gives me an idea of not just what zero momentum is, but the actual slope of this line actually tells you whether the bias is going to be to the upside for people that are following momentum on that time interval. And because I'm putting all the boundaries of time from all the different time frames on at once, I could see when there's going to be a collective movement on many different scales at once that's going to add pressure. And when I look at this, there are very many boundaries right now that are actually sloped down in the intermediate and short term, with lots of space between the boundaries and these upper boundaries that represent the extremities of what market movement would normally be within those time horizons. And right now, what it's telling me is that the market, since we've corrected from that high at 2740, it's pulling back into a dominant time frame. I only want you to focus on this purple boundary. Don't look at any other lines. All these other lines that you see here are for the algorithm, but just focus here. The only line that's going to tell you where you should be buying or where you should be focusing on acquiring silver or knowing if it's in a bull or bear market is if this purple boundary, this middle purple boundary that I'm tracking right now, is sloped down or sloped up. And you could see, if I was to zoom in over here, you could see here, this is our current bar. Now on the screen here, do you see this thing that says 25D up here? That means each bar has a range of 25 days. Most people will look at charts on a daily, weekly, monthly basis. So this would be closer to a monthly bar, but the methodology I use is so specific, it hones in on the exact time horizon that will represent the dominant momentum, and it accounts for all actors in the market. And it's telling me that there's going to be a positive bias on the upside acting as support along this purple boundary. And so technically right now is prices come down to the upper part of this boundary, the upper extremity, and it's pretty much bounced off of it right here. Now, in reality, the market could actually come down as low, it could come down as low as $20.13, or perhaps even $18.85. And even the lower part, if there was an overshoot, and let's say we had a situation where there was another surge in the pandemic and they had to use silver and gold as collateral, or people were freaking out because some of the mines had to shut down and there was not a lot of demand at the time because everything was off scale. So at that point, you could argue and say, hey, even a price level of around just above $17 would actually still put the silver market in a normal secular bull market. But looking at all the different timeframes that I look at, it seems to me that a logical area that people should be buying, they should be buying in the area. And this is not a recommendation to buy or sell. This is strictly educational and based on what I see. You should consult an advisor. But what I'm seeing here with this methodology, and it's something that I rely on heavily over the years, which was able to capture a lot of bull markets and long-lasting bear markets in silver, is that I'd be a buyer in the $22.40 area, like where we are right now, down to around the $20 area. And if for whatever reason the market for an intra-week period or intraday period happened to like poke into below 20 or into the 18 or 19 area, then I would add to it. But if people have already allocated, and let's say they got carried away and they just bought, near the high, I believe that the move that's about to play out, and you could see this purple boundary, which is slope down, meaning positive momentum bias, is actually sloped out going into May 22nd, 2023. And there's a little kink in this boundary. You can see it kind of slopes down into August 2022, then it slowly rises. So it doesn't mean silver can't go up, but there's definitely a headwind on the momentum bias area that it would need a lot of fundamental information to carry it higher in that period. But here it doesn't even need any new news information. Even just the old information about everything we already know about why we should own silver would actually start getting catalyzed and interpreted in a more positive light. Because one thing we understand about markets is it's run by humans, and humans are behavioral creatures that base their decisions and the type of news they look at based on their bias. So that if you have an indicator that tells you that there's a composite of traders on many different time horizons that are all going to be synchronized and seeing and interpreting positive sentiment bias, then the type of news they're going to try to look at to confirm their bias is going to be positive. But in a bear market, it's the opposite. Even if the fundamentals are great, people are not focusing on the great stories. They're focusing on any negative story. And at any given time, there's always a buyer and a seller. So there's always going to be a negative story to support a seller. So this gets me extremely excited. I look at these kind of charts every day. And this just happens to be the longest term chart I'm looking at because I'm trying to give you a broad view. But I do provide market intelligence to individual active traders and investors that want to know day to day what's on my trading screen. And I look down right to the tick level and minute level so that I could actually see these kind of structures and patterns replicating, and you could trade them on any scale. But I think for the person that's going to be investing in precious metals in terms of a store of value to protect against an inflationary episode over the coming years, they're going to want to look at the dominant time frame that stretches out and matches where we see the inflation coming down the line. And time-wise, I see a few different areas. I see it could happen as early as this October, which means at any instant now, because some of the shorter timeframes could technically show that we could have a dramatic rally starting literally instantaneously. But if it doesn't, there's a few dates that show up in the middle of October, the early part of November, and then the middle of December. I can't go into great details on the shorter term timeframes and the type of specific equities and the type of ETFs and the ins and outs of all that, because that's something that it would be unfair to my clients that are actually paying customers for that level of information. But I do believe that with some of the insights we provided today, it could keep you on a very clear path for why you should own silver and why you should not be concerned about the recent price action since earlier this year.
That's fascinating, Efrem. I really appreciate you sharing that with our viewers, and especially getting to the details of, the price levels that you see. As good times to get in and or to add to positions. Do you like what is the low we're retesting right now, and what do you think the floor actually is? Is it
I mean,
is that 17, just that little bit over $17 mark? Is that the floor? And you think we're sort of
I would be surprised. Like, I mean, the silver market, I'll give you an example. Silver market has very, very little liquidity. So I'd be shocked that it goes there, like, and stays there for any. I think it would be something that you could hardly, you'd be looking at it, analyzing, trying to make sense out of it, and before you know it, you're up in the 22 to 24 area. I believe that is the fair, like, the range where it's trying to consolidate with the volume. That's where the volume is building a base, and everything below the 22 to 24 area is really just artificial, and it doesn't mean anything. So we're in that zone right now. I would, and if you follow the shorter term timeframes, I would absolutely be a buyer of silver right now and take any lower value as a present. And if you don't have more capital to allocate, then so be it, and come back in the third quarter of next year, and come back in the second quarter of 2023. And I believe that investors in that area will be very happy to see how they're performing, both in terms of US dollars and in terms of purchasing power.
excellent. Well, again, thanks very much for sharing with our viewers, and for taking the time to sit with us today.
Well, thank you very much, Philip. It's really a pleasure to be on the show today.
Thanks very much to all of our viewers who tuned in and listened today. We really hope you enjoyed our content. And if you did, please drop us one of these below, and be sure to enter your comments and questions down below as well, so that we can address them in future episodes. Thanks for watching Line in the Sand.